Hey everyone, welcome back to Corporate Decoder, the place where we dissect the documents that Wall Street doesn't want you to read. Today, we're diving into Enzon Pharmaceuticals' latest annual report. It's a wild ride involving potential acquisitions, some financial maneuvering, and a whole lot of waiting. Let's see if this pharmaceutical company can make a comeback or if it's destined for the corporate graveyard. So, Enzon Pharmaceuticals filed their annual report, basically saying, we're still here. But instead of selling drugs, they are trying to become an acquisition vehicle. Think of it like a corporate shark swimming around looking for another company to swallow. Now they have these things called net operating loss carryforwards. I know it sounds complicated, but it just means they have losses from previous years that can be used to reduce future taxes. It's like a coupon for not paying taxes. The address is unimportant. What is important is that the company is hunting for acquisitions. That said, they haven't found any suitable targets just yet. Think of them as a picky shopper with a lot of money to spend, and nobody wants to sell their business to Enzon. Also important are the outstanding shares, because these will be very important later. As of mid-February, there were about 74 million shares of common stock out there, so buckle up because that's a lot. Let's get to the risks because Enzon acknowledges that its search for a company to buy might fail, and that could make the stock price decline significantly. Basically, if they can't find a company to buy, Enzon's stock might not be worth much. The company also recognizes it may engage in transactions which could mean a change of control of the company. Another thing to consider is that Enzon's revenue sources are limited and they expect to see little revenue for the foreseeable future. If they don't make any investments that result in additional revenues for the company, things might look grim. It's like a one-trick pony, but the pony forgot its trick. Enzon has outsourced pretty much all of its corporate functions, which means they are very dependent on other parties. If any of the outsourcing is not adequate, Enzon might not be able to manage its business effectively. It's like a general that has outsourced its army. One of the things that Enzon has going for it is the net operating losses, because it is positioned as a public company acquisition vehicle. If they are unable to make any acquisitions, there is no guarantee that they will be able to make use of them. Next up is a financial consideration, where common stock ranks behind the company's Series C preferred stock. This has very significant implications because the common stockholders will not receive dividends unless the Series C preferred stock requirements have been met. Also important to consider is the fact that Carl Icahn, directly and indirectly, owns almost 50% of the company's common stock and most of its preferred stock. That means that this person may have interests which differ from the interests of the common or preferred stockholders. The price of Enzon's common stock has historically been volatile and may decline significantly if they can't acquire a business, which should be a big concern for current investors. The fact that Enzon's stock is only quoted in the OTCQX market means that the liquidity might be very limited. The declaration of dividends is up to the board, but there's no guarantee they'll actually declare them. It depends on interest rates, what's coming in, and expenses. Basically, will they have enough money to pay dividends? To prevent other people from taking over the company, the board has adopted what is known as the Section 382 rights plan, which might delay or even prevent a change in control. The board is saying that the rights plan is structured to protect the company's net operating losses. The company's Series C preferred stock can be paid either in cash or by simply increasing the liquidation value of the stock. This could be a problem because the company might not have the capital to repay it at the required time. There's also the aspect that the Series C preferred stock is not convertible into common stock, so holders of Series C preferred stock have no rights with respect to the shares of the company's common stock. Enzon has limited operations and have not adopted any cybersecurity risk management programs or formal processes for assessing cybersecurity risk, but also mentioned they did not identify any cybersecurity threats. Now let's get to the numbers. Looking at royalties and milestones for the year, Enzon made only $26,000, basically pocket change. Interest income, however, generated a couple of million. General and administrative expenses went up about 30% from the prior year, mostly due to professional fees. This might be from the acquisition hunts. Because they made money mostly from interest, Enzon utilized some of its net operating losses. This resulted in a deferred tax expense of a few $100,000. Since 2022, Enzon has been able to redeem the Series C preferred stock at any time for a specific amount. Also, holders of the stock can demand that Enzon redeem their shares if there's a change of control. Enzon believes their cash on hand will be sufficient to fund operations until 2026, but the company can't give any assurances on royalty or other revenue. A critical accounting policy of Enzon is the estimation of their income taxes. They have to estimate whether they'll be able to use their net operating losses in the future, and if not, they need to create something called a valuation allowance, basically a rainy day fund if those tax benefits never come to fruition. They also don't anticipate any adjustments from their tax positions. Finally, a recent pronouncement requires companies to disclose the financial performance on their reportable segments. Enzon did not have significant segment differences. As for future events, Viskase Companies is interested in a potential business combination with Enzon, and a special committee was formed to consider the transaction. Looking at Enzon's direction, they are clearly trying to revamp and redeploy. However, if they can't secure a good acquisition or investment, Enzon might struggle. The biggest risk might be Carl Icahn, who owns around 50% of the company and could influence the company direction. The biggest opportunity could be to utilize their tax benefits from their previous operating losses in the future by securing a good investment. In conclusion, Enzon is at a crossroads. Whether it becomes a successful company or just fades away depends on whether they can find the right target to buy. They are very reliant on third parties, and the company has very little revenue streams. They are basically just hoping for interest income and a future acquisition target. Thanks for watching. If you enjoyed this deep dive, please subscribe for more corporate dissections.